So there I was, talking the stock market with somebody who's close to me. They're super excited about getting in investing, but they only have a small amount of money to put in every week. Kind of like this $25 that we've been talking about for middle-class Americans. Now, while they're super excited, they actually tell me they're concerned because some of the stocks I talk about they feel are way too expensive for them.
Tesla.
Not only that, but they're super excited about investing into another company. In this case, it's Hertz, because their $25 will allow them to buy 10 to 13 shares of the Hertz company rather than a fractional share of Tesla. That's right, you guessed it, they're considering and investing in Hertz over Tesla. Hello, I'm Andrew and welcome to the Dad Manual. And this is my attempt as a dad and only a dad to talk about why the stock price itself is completely irrelevant when you're evaluating a company. In addition, this is week 2 of our Financial Friday series where we invest $25 a week in 4 separate ways and track its progress throughout a year. And as a reminder, I'm not a fiduciary, I'm not a financial advisor, this is just for entertainment. Please do your own due diligence and don't just blindly follow somebody on YouTube. This subject just has to be addressed. See, when you're looking at the stock price of a company as it's being traded on the stock market, that's only one part of the equation of determining what the value of the company is. See, stocks themselves are tiny shares of the overall company. And we refer to the total number of stocks that are available of that company as the amount of shares outstanding for that company. The value of a company, as traded on the stock market, is actually called its market cap. And you calculate a market cap by taking the total number of shares outstanding times the price that the shares are trading at. This gives you the market cap. Basically, the equation looks like this. So if we take a look at an example, say Tesla, we have 959.85 million shares in the shares outstanding. At the time of this recording, shares are trading for $815. That means the company's market cap is $782.27 billion with a B dollars. Now, if we take a look at Hertz, we see that there's 156.2 million shares existing that are trading at $1.57 for a market capitalization of $245.24 million. That's million with an M, not billion with a B. And now you may be looking at the screen and saying, well, yeah, Andy, all you did was just prove that Hertz is cheaper than Tesla to buy. Listen, I want you to rethink the word cheap in your vocabulary. Instead of considering something cheap because it's on sale or because it's less than something else in the now, I want you to start thinking of the word cheap as, how is it valued now in comparison to what it will be valued in the future? Because unless it goes up in value, it's really not cheap. If something goes down in value, it actually is expensive. You could buy the same thing in the future for less money. So I'm not going to go into my whole Tesla breakdown in this video. However, I will go ahead and give you a high level of my bear case. Basically, I'm thinking to myself that Tesla in 2025 should be worth $4 trillion. If I take a look at today's market cap that I mentioned earlier at $782 billion, then that means in 2025, I expect Tesla's share price to grow by more than 511%. This means that any dollar I put into Tesla would be worth $5.11 in 2025. Hertz, on the other hand, is probably going to zero. That's because they've filed for bankruptcy and they're restructuring their debt. When that happens, shareholder value drops down to zero, and if that happens, you'll lose 100% of the money that you put into your investment. So Tesla, for this instance, is going to go up by 511%, where Hertz is going to go down to zero and you'll have a negative 100%. To me, that means that Tesla is much cheaper than Hertz is right now. Well, now that we got that hullabaloo out of the way, let's go ahead and focus on putting our money into the stock market this week. So you can see here in our value stock account, we picked up another $25 of Dropbox, and by doing so, we picked it up on a little bit of a discount compared to what it was. We're actually up 1% as far as the whole week goes. If we look at the weekly chart for Dropbox, it started out at $23.50, and we've been able to make basically 50 cents on our 2 shares so far. you're going to see it go up and down like this. And I don't want you guys to go ahead and get worried, because if we track this back an entire year, you can see there's lots of peaks and valleys here. What's important isn't trying to time the market when you're putting the money in. It's time in the market that's important. So moving on to our dividend stock account, you can see that we also purchased another $25 of Verizon. It too has had a pretty volatile week over the last 5 days, and it's actually gone down a little bit since we purchased it first last weekend. Now that's okay, because when we look at red days and we're seeing that it's negative, we should look at that as buying it on a discount if we truly do believe in the company. Verizon's a stable company. It issues right now a 4.5 to 4.6% dividend, depending on what your purchase price is, and I don't see them going away, so I think this is still a stable play. So moving on to our growth stock account, you can see we put another $25 into Tesla. You can see on the chart here, Tesla's had a pretty wild ride going from 840 where we purchased it at, all the way up to 868, and then back down to what we picked it up for today at 805. Now what's important about this is you need to understand that when you're actually buying the dip, you're changing your cost basis here. That's important. That's good. You should look at red days as being buying opportunities, especially if they're stocks that you believe are going to go up in the long term. Don't get scared just because you have price action that goes up and down. Instead, look at it as an opportunity to pick it up on sale. And lastly, our S&P 500 account, you can see we put another $25 into it, and you can see according to the chart, it didn't really change all that much throughout the week. It might look like it has a lot of peaks and valleys, but overall, we're talking the peak to the valley is maybe 1%. Where, say, Tesla, we saw that just from Monday to today was 4%. This is going to be a lot more stable. It's going to give us good returns, but it's something that when we're betting on the U.S. economy as a whole, that we can be very safe in putting our money into an S&P 500 index. Well, that about wraps up today's episode. What I want to know, though, is what cheap stocks you went out and purchased this week. Tell me about it down in the comments below. And while you're down there, don't forget to give me the thumbs up and hit that subscribe button. We post videos here every Monday, Wednesday, and Friday. And until next time, I'm Andrew Sherman. This is the Dad Manual. And remember, failure isn't bad. Failure to try and learn is. Have a good one.